Hello, everyone, and welcome to This Week in Hospitality Marketing, the live show number 353. I am your host, Lauren Gray, and thank you so much for joining us live. And for those of you that will hear this later on a recast, thanks for doing that. Anyways, for happy Friday the 13th for us, 11:30 a.m. Eastern U.S. time. For those of you watching us around the world in 39 countries that we are in, perhaps more today, who knows? Haven't looked recently. Thank you so much for joining us and for the odd timelines that you or time zones that you catch us on. So today's topic kind of came out of an inspiration of dialogue with a few clients of ours, and certainly not worth pointing out or needing to talk about why and who and so forth. But it has come back into discussion as travel has come forward in the sense that it's coming back in with all of its tribulations as to increased costs, inflations in the US, the cost of fuel, the cost of living, supply chain issues that are still around, and what have you, all the bleak things that we keep referring to. There's also the fact that financially, people are looking at how they can navigate their financial requirements for their travel plans. We'll get into some of the granularity about that. But our topic today, that we always try to focus on only one thing for the hour, and that is point of sale loans, potential for profits or problems. And the reason why I bring up the paradox of it being a profitable possibility, blah, 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 lots of P's today, or problems, is because there is a give and take to this. For those maybe unfamiliar with point of sale loans, what they are is an introduction of another method of payment. Obviously, when we are booking for our hotels, we're offering the ability to create a point of transaction, which usually 99.9999% of the time is a credit card. We don't send cash in the mail. We don't even send checks in the mail. We don't even really take checks anymore when it comes to that. Just because the delay process of verification and validation. We have debit cards, which are a credit card version of a check, really, in all honesty. It's a application of a charge against existing funds compared to credit extensions of credit cards. But as the interest rate has gone up, and the interest rate will continue to go up in cards, there's a cost factor associated with those as well. So, what has been brought into several markets, not just in hospitality by any stretch, but that's our focus, is the ability that in the method of payment, in your e-com funnel, you've made your choices, you've made your room selections, and now at the end of that path is method of payment selection. Of course, you can do things like PayPal, which offers credit, Amazon, which offers credit, which doesn't always connect to your method of payment places. Um, but now there's others that allow you to say, hey, if you would like, we can stretch this cycle of payments. It's not an upfront cost for you to pay now. Now, obviously, with credit cards, you have some delay factor in the sense that it's not taking money directly out of your account at the moment, um, and allows you to break it up into pieces. Now, from a logistics point of view, the process is different in different platforms, and we'll get to platforms in particular by name and so forth in a little bit here. Um, but usually, what will happen is based on the amount that you're looking to purchase with, like obviously a more expensive place or a longer duration stay, you're going to have a higher price tag when you add all the fees, the costs together, and so forth, taxes, and resort fees, and everything else like this. You're at least several $100s, if not maybe potentially several thousands of dollars. And so you're faced with the putting it on a credit card, which has its own costs and fees if you don't pay it, clear it up within 30 days or whatever the time frame they offer you, or putting it on your account, your bank account, paying it directly out of monies that you have and spending the money right off the bat. For those people that don't have that flexibility cash flow, credit card is the first natural option. These are the next option. And basically what they do is they say, we're willing to loan the money to you. Nothing is free. And to check to see if you qualify, they do what most of them, not all of them, do what's called a soft ping on your credit, which means that it doesn't cost you credit reporting points for a hit to your income verification. That's where the cost factor comes into you, that when people ping your ability to pay back a loan, not just who you are identified wise, but actually the ability to pay it back, that's when you suffer credit point reductions because you are asking the credit unions, peoples, not credit union, that's not the right word to say this, but the credit reporting experience and so forth to verify or validate that what you're saying is your income is what they last know of your income because they keep track of your connection of income. And that's where you cost your credit points. Credit points going down means things cost more for you because your credit rating goes down. So you try to do that as few times, if as little as possible, let's put it that way, so that you don't suffer from these inquiries associated with validating your income for the credit that you're asking for. So these platforms will go over to a soft ping saying, okay, we verify for the information we're asking for you. You are who you say you are. And so, yes, we're willing to extend terms to you, but those terms, the condition of those terms, will be based on what's called a hard ping or a hard credit check, which again goes back to verifying your income and the capability of paying back a loan. And also indicating what your real credit rating is at the time that you're applying and so forth, based against the amount that you're borrowing, which is then calculated against your overall income. That math works out to what rate they're offering you. This is where it gets a little on the heavier side because depending upon your credit rating, depending upon the amount you're asking to get financed, will dictate the percentage of the term of the loan that they're willing to extend to you. The average range right now is anywhere from 7% to, ready for this, 30%. Ooh, okay. Um, so you would have to be accepting those terms. Now, if you're feeling that you would prefer to take advantage of the opportunity to dilute the cost to you rather than one single hit cost, because even with a credit card, you'll have to, if you don't want to get hit for penalties or not penalties, but interest rate on the credit that you're being asked for, you would probably want to clear it within 30 days. So you're looking at the fact like, well, this is a pretty big ticket. Let's make numbers up. Let's say you're wanting to book a ticket or a travel trip that the ticket cost comes to about $5,000. Okay, now this could be for your flights, your hotels, whatever. $5,000 for the transaction you're looking for, and you don't want to put it on your credit card, which we'll get back to later, because you don't think you'll be able to pay it off in the 30 days, or without then paying interest afterwards. And again, we'll get back to the credit card scenario in comparison to this. You see these as a term that says, well, I'm going to be leaving here soon. I'll go enjoy my trip in the next couple weeks that I'm going to be going, and then I'll take the next 3 months and more, depending upon what you want. There's terms that you say, well, I'll pay it off in 3 months, pay it off in 6 months or longer, if that's what you're asking for. And it's okay for me. It's worth it. I get to take my trip. I didn't have the cash to do the trip. I don't have the ability to really clear it off my credit card or maybe even the credit limit on a credit card to do this. Another option for why you want to do this. And so this gives me an opportunity to enjoy the trip that I want and then break it down, and I'm willing to accept the interest that they're charging me for. That's the profitability aspect of it, not from you, the person that's offering the product. This is the profitability to the platform that's offering the service. Okay. And we'll make the distinction here in a minute. So you're able to convert the person to come with you. You're, as a hotelier, say that they're financing it because they're wanting to stay with you and the bill's going to be $5,000 to do it. You get the booking, and this company flips the bill and pays for that person's booking. So you get what you wanted. I got the booking, a booking that I might not have gotten because it might not have been affordable for the person to get it, or that they would have figured out that they don't want to do it because it's a little too rich and they might go to another place, whatever. You got the booking. So in your world, that was a success story. You gave them a payment of option when they were booking. They exercised that option compared to the other options you presented to them. You get paid by the company that offered that financing for them. And at that point, it's all good. You got your booking, you move on. The company that offered that credit, and there's a variety of them, is now burdened with, of course, what any place that does financing is for, and that is the collection of the monies that are owed to them, plus the interest that they're charging for having extended that credit. So their profitability comes from the margin of the interest that they are charging to have lent that money to you, and that is their profitability. The user is faced with the fact that they're paying whatever interest rate they agreed to, 7 to 30%, based on what they're borrowing, as a condition for their ability to stretch it over the period of time that they were wanting to do this for. Now, this is a very relatively simplistic way of describing, because the terms that get offered to the guest have a lot of conditions to it. Again, their credit rating, their ability to pay back, so forth, the amount that they're borrowing for this transaction more influences the percentage of cost for the loan. And this is all calculated from the provider side as a risk value. Okay. What's the propensity of this person based on their score, on their history of paying back their debts, which is what their score is relevant to their income level, to the amount that they're borrowing, what is the risk exposure to that company? And from that, they determine it's either a very high risk or a low risk. And that impacts the percentage of the loan. If you're a low risk, then they figure it's easy enough that you're going to be paying it back. And they might extend a lower interest rate, like the 7%, compared to a high risk that says, you know what? We're going to make sure that the amount is paid back as fast as possible because there's a risk factor that you may not finish the debt. So we're going to have a high interest rate because we're really at a higher risk for lending you this money. I'm not saying that's how the math works, but just out of common sense, it seems to make the correlation between the two. So let's just take the worst case. I'm borrowing the $5,000. I'm a high risk person. And so I'm paying 30% interest. Now, that's not just 30% of the $5,000 loan saying, oh, 30% of that's another $150, $1,500. So I'll be paying a total of $6,500 for this. No, it's 30% interest on the rolling balance. And if anybody knows about their credit cards, it's not about just a chunk of money that's being added to it. It's about a perpetual percentage of cost for the money you're carrying from one month to the next. So it's not just a $1,500 impact on a $5,000 loan at 30%. You're talking about upwards of 3 times the value of what you borrowed, depending upon the terms, 3 months, 6 months, more than 6 months, whatever that you've asked to do this. These microloans, these point of sale transaction loans, are meant to alleviate the apprehension of the affordability of the purchase. Now, these platforms refer to the fact that they improve your conversion value because of the offerings that they provide you. You're taking literally an obstacle, an obstruction of transaction out of the way of the consumer. I don't have a credit card that has a limit. I don't have a credit card that can handle this. I don't want to put it on the credit cards. I don't think I want to pay it off in the time frame that it would then not cost me the money of the terms with that credit card. Therefore, this gives me better terms in the sense of length of the loan, even though it's at a higher price, because I still plan on paying it off a little faster than they're willing to give me the loan time for. They're banking on that, as with all credit cards and anybody that gives loans, including loan sharks, is that they're banking on the fact that you're not going to be able to pay it off. Those furniture stores that offer you zero interest for 2 years, well, if you don't pay it off before the 2 years, you should read a nice contract of what happens to all that accumulated interest. It's not zero interest. It's if you pay it off by the end of 2 years, you really didn't have to pay additional fees. They bank on the probability that most people don't. And then they get to take all the accumulated interest that they weren't charging for, plus the interest that they have to move forward with. So they get a really large number at the end of the 2 years that you didn't pay all your money for. They get to take all that interest for the entire purchase, add it to what you still have left as a balance that you didn't finish off, and then accumulate that to future interest that's usually really, really high that you didn't think you'd get to. Remember, the benefit of the structure of this is to the benefit of the lender, not to to the lender from the lender, not to the person that's taking the loan, because they're taking the risk. And this is business. It's not. I'm not here to bash people that lend money. I'm here to go and make it clear as to what the effects are by borrowing money. Now, again, the touting of the sale of these platforms is based on the reduction of an obstacle for people to purchase. The idea consistently is that it's being offered to people because the amount of money that is going to be involved with the purchase of their trip is hitting this threshold of determining how to pay for it. The interesting part is that the platforms usually come in as an option to anybody. They go from a range of $100 to $15,000. Well, you're really going to take a loan for $100 transaction? Who knows? But the idea is that it's not limited to what you think would be the people that are at the high end of a purchase. It's literally being put into your e-commerce funnel all the time. Then, unless you're a $49 room night hotel and people say they're one night, it's unlikely that you're not going to see this option of payment in your e-com funnel the whole time. Being a geek about data and, of course, the securities that are associated with it, in order for that software to function, they have to accumulate data. Now, most of the platforms will go over and say that they bring the user to their platform to provide the data necessary for them to determine the loan opportunity for them. That's true. But in order to have that trigger go that way, they have to be at the point of transaction that they have to pull data from your ecom funnel to know what the person is asking to be lent money to about. In other words, they need to pull data from uh, your transaction point where it says this is how much it'll be for your trip, and this is who you are. And then you say, well, I'd like to pay with this possibly as a loan. That loan software, by a code that you put in your ecom funnel, reaches in and keeps track persistently of, okay, well, what amount are we talking about? It pulls that data out. Who are we talking about? Okay, so you're Lauren Gray, you're looking at this. Okay, fine. Now, Lauren, we want you to fill this information, so put your name back in. This verifies data, doesn't just first accumulate the data. It verifies that the transaction is connected to the person asking for the loan. That has to be a condition of this. From that, they then have to say, you're looking at buying something for $5,000 because they pulled that off of the ecom funnel. Also, from that, there is additional amount of data that we all know goes through the ecom funnel. The geography of me, the information I've provided in there, the dates that there's a tremendous amount of information in the ecom funnel associated with these trackabilities. Now, in contracts with those, you can look at those contracts that they provide you, and they say that we follow all standard guidelines, so forth and so on. But they also create an exception to themselves in their contract saying that they need to take this data to verify the transactions that they will be providing. So, in other words, we follow the rules until it applies to us, which means our rules are we have to need this data to do our business. The questions about how do they store this data, how long they restore this data, how do they quantify this data, how do they attach it to the guest, particularly, and how do they follow those guidelines for all the rules that we have to follow between GDPR, CCPA, and so forth, as to say, for instance, I, Lauren Gray, go back to the hotel that offered this payment method and say, I would like to know what data you know about me. And the hotel, being the due diligence steward of this, shares the data that they have. But what they don't have is the data that was shared to this platform that provided the payment method, the point of sale loan, because it's not in our databases. And so we provide, and they say, well, we want all, no, I want all my data removed from your database platform. Okay. And we do diligently comply with taking all that data away, but we don't control the data that was gathered by this platform. And then what happens? Well, we're trusting that the platform that we put into our system is also following the same guidelines, which contractually we already know they don't because they say that they're the exception to it. And what, for any reason, they either have a data breach and or they send out some sort of marketing for themselves to re-incentivize the person to use their platform again, referring to the transaction that occurred with us. And now all of a sudden, that person go, wait a minute. I went through all the problem of going to that hotel and saying, what data do you have? They announced it. They told, and I told them to get rid of it, and they did. But now you're referring to that very same thing with that hotel that they told me wasn't there anymore. And now the reflection is on the property and not on the platform. And it's a leak that we have. And when we're the ones in the front line of this, where it's like now the guest is coming back to the hotel going, hey, what where did this data come from that I got this email incentive or this text or this information that refers to the stuff that you said was removed? So you didn't, and now we're in a position of either trying to defend ourselves or validate that we did what we said we did. And in fact, then they can be chased down saying, well, you really didn't because you allowed this platform to access the data and then you excluded them from the conditions of maintaining it the way you said you were maintaining your data to comply with GDPR and CCPA and all the rest of the stuff. And from that, you then go over and are now possibly in line with legal issues because you weren't in control of the data that is how it's being used. Now, I'm making this as a worst case scenario. I'm not saying that that is how it's done. I'm not saying that it is has been done. It's just based on what these platforms do and the need of data that they have. These are open cracks to the data storage and compliance capabilities that you are saying you are maintaining when you're already allowing them contractually to pull data, even if the person is resupplying it on their platform. That transaction confirmation still has to be connected to your platform. So all gloom and doom. Okay, talked about the bad aspects of this. And because of that, you're faced with the fact that you're offering a method of payment that you hopefully reduced an obstacle from, improved conversion, just like the platforms that are selling you say that they do. But let's talk about the merit of these kind of platforms in a very pragmatic way. what are we looking for? Now, most of the platforms refer to the fact that most people that use them are savvy, well, stable financially people that are just exercising the option of leveraging the continued ownership of their monies by extending their ability to stretch out their payments so they don't have to keep taking direct hits to their income. I say no. I'm sorry. Just my personal opinion about this is those aren't the people that are using the platform. I'm not saying that they don't, but that's not the primary people. The people that are looking at this as an option are because they are limited in their options of payment. And they're seeing this as an opportunity to forego, delay, or dilute their means of payment for a probably more than they should be spending transaction. And that's who you're looking for. The reason why there's places that you bring product in to get money for is because they have no other means to translate what they own into cash that they need. We know statistically, and I'm doing it for another research on Drive Market, which I'm literally thinking about making another show about because it's so fascinating about drive markets and gas stations and gas station resupplies and who are the most busy gas stations and distances of driving and driving behaviors and so forth. Not to go off on a tangent. The idea is that we are faced with the fact that on average, as Americans, because I'll deal domestically, we do about on average 2 trips a year. One is related and hubbed towards holidays. In descending order of priority, usually around Christmas is the top preferred holiday travel period, followed by Thanksgiving, very close second, and then intermingled between a Mother's Day, Memorial Day, and Easter. Those things kind of float. Oh, excuse me, July 4th, not Memorial Day. Excuse me, July 4th. Memorial Day is in my head because it's coming up. July 4th, Mother's Day, and Easter are the other float dates of holidays that people tend to travel around. Now, each has their distances of travel. There's correlations about how far you travel based on the holiday and so forth. But let's leave it at that. So that leaves one other trip that most people on average take. Okay. And it's usually a larger trip in the sense of length of stay, which inherently means that it's a larger portion of their budget on average for those that reported. And but it's amazing to find this data. Um, is 3% of your gross income is usually related to traveling on average. Obviously, average means middle of everything. There are people that certainly do more than that, and there's certainly people that maybe do less than that, depending upon their income level. It's a proportion of a value. So, of course, 3% of what your gross value is an estimation compared to what average value of income people have. And that has a line. There's a line below 80,000, there's a line above 80,000 for family income. And then there's two splits on that. There's two-person family, couple, and family of more, which can be three, four, and more. And so there's a line for it. Strangely enough, very little traffic analytic data is on solo travel, but usually it's age sensitive. It has polarities as being incredibly young or incredibly old, and very little in between when it comes to solo travel, which I think is a statistical thing rather than an actual numerics thing. Again, tangent we don't need to get into. So you have two travel trips for the average consumer per year, of which one is holiday based. Okay. We know July 4th is in the summer, so that's certainly a nexus of summer travel. If we want to look, and this is napkin math, and that is last summer was an amazing tsunami of demand. We knew it was pent up demand for all of the restrictions that COVID placed upon us in the pandemic and our travel ability. And at the time, there was a lot of legal things as to the need for testing, the verification of not being having COVID, the restrictions of travel, the opening of borders, and so forth. Very heavy influence on why so much business was last summer. Um, so we know historically, prior to even the tsunami of summer, summer is historically a high travel period. Why is this? Well, at least half of the entire spectrum of travelers, whether below 80,000 in family income or above 80,000 income, have a trip in the summer that involves the fact that there's either kids and or slowness of business for them to allow for vacation travel to be scheduled. Okay. But either impact of having family or no family, summer is usually an opportunistic time based on weather and all availability of being able to travel that people find themselves traveling. So let's just make the push to say that the second travel plan, okay, can be nexused mostly around summer. We know that's not true because spring is heavy. Spring break is a key element of that, as well also fall before, with leaves turning and everything else, and before weather begins inclement for a lot of places and reduces their travel interest for that interim travel. Winter has a different segment. But for the most part, volume wise, let's just look at summer. So rates go up, is what I'm saying. We just follow business pattern. From most places in the summertime, rates go up because demand says they can. No rocket science here. So with that, you have the fact that people purchase and recover. If on big ticket items, if I bought a car and now my monthly payment for that car is in part of my budget per month, it impacts my purchase interest. Obviously, if I'm paying substantially more for something, which we all are at this point, thinking of that because of the increased cost of things and inflation and interest and everything else, we're paying more for everything. So these purchase decisions are going up. They're turning into larger numbers. So these platforms are beginning to flourish in their interest because people are faced with the fact that they do not have the liquidity now to make the purchase of the travel that they want. Connect that to the fact of the pent up demand that is still existing, the really true not flourishment of people's travels interests. Because I didn't travel last summer, as an example. It was still too risky for me. That's when Omicron came out. I think it was Omicron, Delta came out that summer, and because of that, where everybody started pushing out in July, August came in very heavy, and so forth. For that whole summer program, I didn't really travel. So there's still a large segment of our audience of our people that didn't do the travel last summer. There was a large audience that did because that you can see the business. Well, now there's more of an equitable demand across the board where even people such as myself that were very hesitant last year are still saying, I want to take my vacation. So there's still people that didn't take vacation last year that are now in the gate ready to go. They're in the breach ready to happen. So the demand should be solid for this summer, even given the fluctuations of COVID's, infection rates and so forth. As tragic as it is, still affecting people's lives. People are still saying, I'm going to go. I'm going to go. So we're going to have this pent up. So there is now also added to the behavior of people the fact that I am not going to miss out on what I have been dreaming about. I have friends that are going to be taking wonderfully large trips that are very expensive. I have we have friends that are going to be on a cruise for 2 weeks in the Greek Isles. We have friends that are going to go to Spain for 2 weeks. We have friends that are going to go across the U.S. in RVs for a month. We have lots of friends that are just, this is it. We're going to do this. And those are some pretty hefty prices. So with it and the fact that their expenses are going up, they're looking at, do I want to run it on a credit card? And yes, the interest rates on credit cards are going to change. I have changed and will continue to change. They always allow themselves the gateway of saying, well, we gave it to you at an introductory offer of XYZ%. But at the end of that mandatory offer at the time, it's going to go up to whatever we think it should be based on, as it usually is connected to, prime interest rate. And with the interest rate having been hacking up half point at a time, that means your credit card interest rate is also going to go up. And for most U.S. consumers, they roll debt. Not all consumers clear debt every month. Not everyone can say there's zero debt. And so because of that, they carry notes. They carry debt, usually in the form of credit cards. Credit cards have limits. Also, even though that may be a lower interest rate than what we're comparing against to these point of sale loans, the fact that it would blow out their functional credit card so they can't use it because they have a huge ticket item of a travel expense on it, that is not an option for them. It's like that credit card is what I use between paychecks to make sure I can buy groceries, pay for gas, which keeps going up, and everything else. So I don't want to burn that card out by maxing it for this purchase for the travel. So this loan thing, this point of sale loan thing, looks pretty good. Sure. And yes, it's a higher interest rate than what I can get that I have on my credit card, but it allows me to continue to use my credit card for what I use it for without maxing it out, putting it on a shelf saying I can't use it until I burn it down. So there is a value proposition for it that it fits that niche there. It's not, however, the way it's portrayed in most of these platforms of affluent, well financially stable, good credit scored people. They're just leveraging the option of being able to defer and dilute their payment cycle rather than lump summing it. I would also say that when it comes to looking at using these debt functions to it as well, is the risk factor of when the transaction is occurring versus the requested time to pay it off uh, is something that has to be of concern to people in the world of, again, purchase and recovery. I do a big ticket item. My air conditioner at the home died, and even though I knew it was going to eventually die, it wasn't like I had a whole separate piggy bank where I put money in, the same when the air conditioner dies, here's the money. It usually means it just gets hit on the monies that we have from whatever account we need to spend it from to make the fact that we have to replace the air conditioner. And there's loans for that too. I mean, everybody's willing to offer a loan, but that kind of big hit may also mean it's like, well, you know what? We were going to go over and think about replacing the lazy boys here or something. Let's push that out a little bit. We don't need to be doing a big ticket item, then another big ticket item, put ourselves into liquidity jeopardy where we don't have a lot of cash flow because we're buying these big ticket items. There is a recovery period associated with big ticket items. This allows for the big ticket travel item, which is, we just talked about, a heavy demand opportunity, coming into a heavy demand opportunity. There will be a higher ticket item because of all the costs associated with the travel. And in a strange way, these kind of point of sales things, I think, would work better towards the aggregate purchase place, like a travel agent, um, an Expedia, where you're saying, you know what, rather than have a micro loan or a point of sale loan for my accommodations only, and then over here, I'm going to ding my credit again because I'm going to take my airline tickets and try to get a loan for it. And then over here, I'm going to, because each one of those dings your credit, reduces your credit score, which makes the cost of everything for what you're doing go up. It's a circle. The more you use it, the more it's going to cost you because the more your credit rating goes down. So I think with the point of sale transactions, the consideration is from you who are providing it, the actual value of improving your conversions for those who use it. The reality is, it is not to the demographics that are pitching you it. It's the demographics of the people most likely to end up using it, which means you're also dealing with the fact that people are buying beyond their means. That's why you take a loan. Now, part of the promotional aspects of this is that they say, well, you can offer 0% interest for certain brackets of time to incentivize people that, hey, if you do this, we'll give you 90 days, same as cash, meaning you have 90 days to pay it off before you have to pay interest that we're going to hit you with. Again, like I told you, the furniture store example, be careful because the interest rolls on the large first purchase amount, regardless of how much you're paying against it. And then boom, that gets added into your total balance due, plus also the interest that's now related to it. So those the backloaded kind of stuff is dangerous. It does improve the saleability of this, because for me as a person saying, well, I don't want to put it on my credit card. Let's make a scenario. I don't want to put it on my credit card and max out my credit card because I use my credit card to float me between paychecks, and I don't want to burn the card and not be able to use it for those intern places I need cash for gas and food and things like this. So this loan is an option. They're offering me 0%, okay, which on the back end of this, the hotel, the accommodations that I'm looking to stay at, they're going to pay the fees that the service provider that's offering the point of sale loans would normally get. So to be able to offer that 0%. So remember, nothing's for free. It would be out of your pocket to get that conversion. But again, you're looking at them coming in and staying for however much and having the booking reservation that they have. So that makes the consumer think, well, this is pretty cool. I'll get rid of it. And, I'll pay it off in 90 days. They're actually banking against you not doing that, because then they can make a lot more money for the fact you didn't pay it off before they can start hacking you for interest. But there is a sales perspective value from the accommodations, the resort, or the hotel, that thinks that by offering that incentive of 0%, payment, same as cash, over a period of time, that you'll even make it easier for the consumer to make the purchase decision, because it might be past their financial capacity to pay it now and normally the way that they normally would. They don't want to get out of their bank account. They may not have it, or they don't want to have that much of a hit on it. And they don't want to put it on their credit card because they don't want to wipe out the card or extend that card, even though it might be a better interest than what's being offered to give them the loan. Okay. So there's that value proposition to it. Here's where I think what doesn't get discussed that needs to get discussed is who's in the line of perception when things don't work the way they're supposed to. Meaning that the person overextended themselves because of their innate desire. I'm going to take this vacation. I've been waiting for 2.5 years to do. I'm going to do it. I know I can't afford it, but hey, they just offered me terms. I can go over and pay this. Well, they do that, and then they show up. First off, what do you think your ancillary monies you're going to get from this person are? If they had to take a loan out, not just metaphorically, to get there to you, how much money do you think they're going to spend in all your restaurants and spas and golf and everything else like this? Now, you might have the person that says, "I'm living it up and blowing the, I'm going to do everything, and just I'll deal with it later." You'll have those people, but you have the other ones like, "Well, we had to take a loan to get this far, so let's bring more food with us than normal, aka cooler. No, we won't be able to go to the restaurants because it's pretty expensive. And so we'll just eat what we brought or go to the grocery store and sneak it into the room or whatever if it's nearby. We're not going to go to the golf courses. We're not going to rent the kayaks. We're not going to rent the sailboats, whatever. But we're happy to be here. And again, we took a loan to be here. So let's enjoy it as best we can and we'll cut the costs as best we can otherwise. Okay. So there is the negative impact on ancillary revenue, potentially. The other is perception. It goes bad. There's buyer's remorse. There's regret. There's the burden of it. They say, for instance, they default on their payment schedule with the platform that's providing this for you. Do you think they're really going to look at the payment platform as the culprit to the problem? Or are they going to look to you, the resort who offered them the means to pay it this way? And now they think you're the one that's ruining their credit, chasing them down, looking for collections, mad at you for not fulfilling what you were going to pay them, so forth. Don't you think they're going to reflect on you for any inability that they or the provider, as the circumstances of their life, they're being chased and pursued because they're not paying on their debt. The interest is skyrocketing. They're heavily deeper into problems because they took that loan to come and stay with you. It is going to be reflected, I believe, strongly on the resort or the hotel that they took the loan to go do than they are worrying about remembering the name of the dang company that loaned them the money. And it may be right on the top of the letterhead that they're getting for all we know. But you are going to probably be referred in that context because it's an indication of why you're having to pay the loan back. So you're not out of the equation, even if you're not bannered. I don't think in any stretch of the imagination that these third-party services that are offering point-of-sale loans are going to put your banner logo on the top of it saying that you are the ones chasing these people down. I do not believe that. But I do believe in the context of them pursuing the fulfillment of the loan that they offered is because of the loan that they took for you. That I believe. So I think honestly, in the evaluation of whether to use these things, you have to determine the factor that, as with any decision, what happens when it doesn't work? I mean, that's really why we have contracts. It's funny because I have great relationships with clients and we're laughing and joking and being casual and comfortable and we trust and everything. But when it comes to business, it's on paper. It's not because I don't trust them, but it's trust for verification. It's like, I believe you. But if the person that takes your chair because you move on and up or whatever, and that person comes in and there's nothing there that stipulates our relationship business wise, then it's up for grabs as to interpreting it. So even in the best of days, every relationship is outlined. Think of it like marriage. It's contract. Yes, I will be married to you. It's a commitment by being recognized by other means. So too with this. And so I would be thoughtful of before stepping into these platforms and processes. One of the data that they require to collect and their omission of ability to be held to the same standard of data storage, collection, usage. That is what you're being held to for yourself for your guest engagements because you don't control how they handle the data completely and their garnishment of it. The second is the impact on the perception of the user as to the commitment that they're financially taking and your representation of that in their eyes. The third is the impact on the ancillary values that can be influenced for the fact that they, let's face it, took a loan to come see you. And so for that reason, are they going to go all in, chips in? We're going to burn everything out and worry about the debt over the time it takes to do it. Okay, maybe. But to not believe that these are impacts to the decision process that you should consider before adding this to your ecom funnel as a method of purchase would be foolish, because they are realities to this. Are they truly all the aspects of this? Absolutely not. It is, as with all things dangerous, there is a point of truth that catalysts this forward. It does help some people. It does reduce the threshold of resistance for conversion for some circumstances. It doesn't exclude the idealistic idea that people financially are well stable, very good, and just want to dilute the method of the means of them paying this because they can take advantage of that. They don't care whether the hotel is paying that for the 0% same as cash for 90 days or more. They don't care if it's 0% cash for the company that's offering it to you. They're not likely to offer you zero same as cash in 90 days if you have great credit rating, because it looks like you pay your debts. So you don't represent a means of making money, because most likely you're going to take the loan just to stretch it over paying for 3 months and pay it off and not have to pay the costs to have lent you the money. You don't represent a good cash flow for these platforms. They're banking, literally to the bank, banking on the idea that people will pay the interest necessary. They will not pay it by the time that the interest doesn't begin to accumulate, in anticipation that they will make even more money off of them. They will not give you low interest if you are low or high risk. You're high risk, high interest. It is the way that the method of monetization works. Follow the money as to how these things work. Um, it is that kind of thought processes that go into deciding whether or not these things are there. So let's look at some alternatives of this. We talked about the fact that it's out to try to solve, and I'm so sorry for ignoring you. Thank you. There's comments and I'm not answering them, and I thank you, and I'm so sorry for not answering them. For everyone that doesn't know why I'm looking over this way, if this is a new show for you, is we simulcast this every week, of course, obviously on Facebook, LinkedIn, Twitch, YouTube, um, LinkedIn, Twitch, YouTube, Twitter, as also our TV station, Hospitality Channel, which you can find on your Roku, Google, Apple, Amazon. Just look for Hospitality Channel. We're also an app on your Apple, Android and iOS platforms. We're trying to be everywhere. There's comments on each of the platforms, and I don't often get to see them as I'm waving my hands and talking to the camera. So my apologies for not getting to that. So let's look at some alternative to solve the same issue that these are trying to solve. If the contention is that people are willing to extend past their financial means to take a trip because of the motivation to take a trip, which is understandable given all the circumstances that we're in, then how can we satiate that? How can we address that for some people? And we've talked in many ways about relationships with our guests, the direct relationships with our guests. We've talked about signups and memberships and so forth. But I think one of the elements that works best in this discussion is gift certificates, gift cards. And we've talked about platforms that supply a lot of the comfortability of working with PMS systems and the technology associated with making it easy for your team to work with. But wonder if you were to look at the idea that, okay, we have somebody that doesn't have the means to pull the trigger to stay for when they want to stay for the amount that they need to pay to stay with us for. Kmart, back in its day when it was a very popular retail store, came up with the layaway plan. No, actually, they didn't come up with it, but they made it very popular. And what that was is basically the same premise for people that were wanting to buy presents and products for holidays. They started the holiday layaway plan progressively earlier as time went on, but usually about 90 days before Christmas. And what this allowed is for families who didn't have the financial means to buy it off the shelf that day, or even buy it potentially later because it's closer to Christmas, they could go in and take it off the shelf, go back to the layaway counter, and say, "Hi, could you hold this for me? And I'll make payments on it." Okay. And they would make a deposit on it so that they would literally take the product. Goes back a ways, and put it in behind the layaway counter on a shelf with your name on it. And they would have a ledger for you that said that Lauren, for this $100 item, put $10 down. And the idea was that you had to go in and put some money on this through the duration of time. Okay, there wasn't, you would say, I want to finish it off by a certain date or something, but people mostly knew it was for Christmas anyway. And the idea was that you'd eventually go in as you got paychecks and say, okay, put $5 on it, put $20 on it. And eventually there would come the day that you would get to go over and put the last payment on it, and they'd take it off the shelf and hand it to you. It secured a lot of things. Secured the fact that it wasn't about being out of stock or shippable to you or anything else like this. It was sitting on the shelf in the back in the office there, and with your name on it. And as long as you kept making payments, it would stay there. The day you stopped making payments or couldn't do it, you could walk in and say, I'm sorry, I need to take that off a layaway. And they give you back the money that you had been putting on it, and they put the item back on the shelf. We're talking about the same thing. So how can you, as a resort or hotel that looks at the idea of doing this, do this without a severe amount of risk? Because there is risk. You're lending something to somebody per se. Not really. Think of it this way. We deal with perishable product at our hotels. The room that went empty last night is gone. Yes, it's the same room tonight, but that's tonight's inventory, not yesterday's inventory. And so it's perishable. What you didn't sell yesterday is lost. So the product itself isn't a toy in a box that if it's gone, it's a tangible thing. You can go buy another one. This is a fact that this is perishable. So the product itself is about availability. When you book a room, future tense, you're securing your access to that product during the time that you indicated. If you relinquish that, the room is still there. Now it's available to be sold elsewhere. Somebody else might want it. So if you make a reservation, we usually require that you pay, okay, when you use it. Now think about this. We have cancellation policies. We say, oh, well, within 48 or 24, we used to be like same day by 6 p.m. And now it's up to 24, 48, 72 hours. If you don't cancel it, you're going to pay a certain fee, like one night room and tax. So there's a threshold. Okay. Now we have created better rates for people that are willing to prepay, saying, okay, if you're willing to pay us now for your stay at least 3 weeks out, for whatever it is, then we can give you a lower rate because you've committed. You've given us money to say, I'm going to be there and I'm going to pay for it. Because when you do a prepay offer and say it's substantively less cost than having the flexibility of canceling it, 24, 48, 72, whatever your cancellation policy is. And because that, we're willing to give a lower rate to you because you're willing to make a commitment that says here, because there's a penalty that says if you do have to back out of it, technically, according to the terms, depending on how you have them up there, all that money is mine. You said you paid for it. We gave you a lower rate for it, which was the benefit of you doing that. And now you're saying, nope, I want to cancel it. Well, technically, according to the terms, you paid for it, and you said you're willing to forfeit that payment to get the lower rate. Oftentimes, one of the good things that we do as hoteliers is we don't hold to all of that, given the circumstances of why they had to cancel, or there's just a moderate fee that is a little heavy compared to our normal cancellations, but it pretty much is there. And so, comparing that to our normal cancellation fee, if I have a 72-hour cancellation rate for mine, up until 3 days out, I can just go over and call them and say, hey guys, the reservation I had, I got canceled. Sorry. Oh, can we ask for a reason? Yeah, I'm not going to make it. Okay. No fee, no harm, no foul. Well, all that exists. So that means we have control over our product to that degree. So what makes it different to say, hey, if you want to book, okay, and hold it, we already are doing that. If you want to make progressive payments up until the time you stay, what's the problem? Well, it's an accounting problem. Picture, it's easy to handle one account. What if you have hundreds, then thousands of these accounts? So the easiest platform that handles this multiplicity is gift cards. Let them pay into a gift card account that they're literally adding to a gift account as they pay towards their time of stay. If they choose that they have to cancel something like this, you can either have a small fee, which is not a great customer engagement experience, that for the fact that they're not staying and that you now have their money that they want back. Or you can offer and say, well, hey, since you already put this money into it, do you want to buy something else? Do you want to change the date? Do you want to buy something different? If you have other things to offer, that's one way of doing it. But the real value of these point of sale loans is saying that you get the gratification of the purchase and then you can extend the payments past the gratification of the purchase. That's what it is. I'm staying 3 weeks from now at your hotel, but I have 3 months to pay for it. So the risk factor is I got the stuff, and then you have to worry about them continuing to payment after they got the stuff. It's kind of like serving a meal at a restaurant, and the person goes home and then pays you for the meal for the next 2 weeks. You got to trust they're going to pay it because they already had the meal. That's the risk factor that warrants the interest that they charge for loaning that money. That's when it turns into a problem for the hotel to offer that, because that's a risk factor. You're turning into a loan institution that's somebody in accounting balancing out versus what they paid versus what they owed. They've already made the purchase, so you're really chasing them down. It's one of the reasons why I, as a vendor, when I create a new contract for people, usually require first month and last month. Why? Because if at the time where we figure, well, we're done with business, you're done with business, me chasing down a client after we're done with business to pay the last bill of their work that we did for them, we're on the back burner of priorities. Okay. So having that last month at least has some credit equitable towards what we're risking for the notification, because we require 30-day notification. So we have this buffer that says, okay, we have this buffer amount of money. So that means we have a limit of what we're able to do because we've already been paid for it. And if it requires more time than that, then you're going to have to get a bill before we leave the door for us to do what we're doing by the time we do leave the door. Understand? So I would not recommend that hotels get into the loan business. Any means. That's why these platforms exist. If you really want this as a viable option, if you feel it's a truly strong threshold for people to cross over, that they may not have the means, liquidity, cash wise, to make the purchase that they're wanting to make with you. That's the positive of this. The negative of this is all the things we just mentioned. I don't think that a hotel, you want to start floating the fact that you can stay and pay later. Don't think it's worth it. I think in some ways, if you want to, depending upon what you want to create as a relationship for your guests, you may have a means of creating a membership program. The one real big tool that any of us have is the ability to discount what we're offering, not to extend credit for purchase that they already acquired. I don't think this is a world as an industry, as a hotel business, we need to get into. Um, it's a matter of we can certainly abate some of the concerns that people have about immediate liquidity. Um, Let me figure the scenario that I think that our ability to help fits. I have a certain cash flow. That cash flow is not going to change for the next 3 to 6 months. I want to travel 3 months from now to the hotel resort, and it's going to cost me $5,000. Same example. Well, the same inability this month to pay for it now is the same inability 3 months from now to pay for it then. But I have 3 months between now and then to put money towards it so that I can afford to stay there 3 months from now. I can split it up over 3 months. Now, going back to my piggy bank example, I don't have a piggy bank sitting on the side for a trip to XYZ. Okay. I don't have that. We don't live in that world of cash and change as much as we used to when I was a kid. And creating a separate bank account for some people do, but most people don't. Putting money aside meant for yourself is fine, but then you still see that balance, and then you might find another reason to spend it, which goes against what you're doing for the reservation you made for 3 months from now. If I can offer as a hotelier an incentive to you to say, look, if you're willing to commit 3 months from now to show up and to pre-purchase, how we reduce the price for a prepaid stay, okay, length of, prepay early. If I'm willing to offer you a lower rate with the auspice that you're going to put money into an account that we maintain for you, aka gift card account, that you're willing to put money towards it so that by the time you get here, whatever balance is left over, if you haven't already paid it off, is due upon arrival, making it easier for you to afford, that might lower the threshold for a lot of people, because that gives them the means to basically to keep dedicated and focused. We're all people of human nature, to say, I'm putting money towards it. So by the time I get there, it's a nut I can satisfy. It's an amount that I can pay, the balance that's still due, that I can pay when I walk in the door like I normally would. And it's done. I've paid for it. It's there. It locks me in a lower rate than I would get if I did it normally, which is, book and standard cancellation fees apply because it's a higher rate that they're being paying. If I can do a prepay rate with the obligation of paying towards it by the time we arrive, and we don't have to obligate the guest to saying you have to pay at least a certain amount. It's just simply a matter of you have to pay to a certain level, okay, or the reservation doesn't get held. And why do I say that? Because say for instance it's $5,000 and somebody wants to scam our offer. Well, here's $250 to do this. Okay, and you're going to pay towards it each time until you get here. Yeah, sure. And all they do is pay two more $50. So they pay $350 towards a $5,000 loan, $5,000 that they are obligated to when they arrive, based on the lower rate they get for us. And then they show up and go, oh, yeah, no, I'm going to cancel it. Or I'm going to get, now all of a sudden we've held their inventory for them at a lower rate that we didn't get. And so it didn't benefit us to create that relationship for them. They can come in and say, well, I can't pay the whole thing or whatever. And now we've lost the revenue because now it's too late for us to recoup the room, perishable product, to somebody else that's willing to pay for us to be at that time, because we got notified too late because we didn't create a condition of them. So I would say that if we were to do something like that, they have to reach a certain threshold of payment towards their overall debt, some percentage that validates that, okay, you spent at least $1,500 towards the $5,000 by the time of your arrival. That means you owe us, $3,500 when you walk in the door. And that might be perfectly fine for them. But at least then we know that there's a commitment to honoring the pre-approved or the prepay rate that we gave them for being there. So that helps in this scenario. So that's one possible way of looking at this. It really comes to, are you willing to take this on internally in a logistics point of view? Your accounting team willing to go over and handle the requirements of communication and commitment of keeping the accounts, even if it's in a gift certificate program, it takes commitment and time for it. I know we're coming close to the end of the time. There's a fascinating article that came out of CNBC.com, which I used as part to our discussion today, which is buy now, pay later can help fund your next trip, but here's what you need to know about these loans. It just came out May 9th. It is fascinating conversation. Fascinating. It sounds like an overused word. It's a very interesting discussion, pros and cons, as to what to be mindful of if you're going to exercise the option of using these platforms from a consumer perspective. I want to add a little bit of our twist of discussion today as to the pros and cons from the providing property, bring this kind of service on board based on the data that they require and the potential for what that data acquiring means to you. Also, the repercussions of perspective from the guests that may not work out the way it was meant to be, and as to how they look at your product in the line of fire when it comes to who they look to for the issues that are coming from it. I want to make sure those were present in the discussion. I'm not saying I'm against these point of sale loans. I'm saying with anything, there's a good and a bad, and considerations that have to be in play for these to be decided to be used within your funnel. Because as you can see by the parameters they put, from $100 to $15,000 as an example of when they show up as a method of payment option, means they're going to show up pretty much for anybody that's creating a transaction for you. And like with any third party, OTAs included, nothing's for free, and it costs, in some perspective, for you to use them, even if it's the fact that it's your perception of you to the guest, or the cost of you covering the costs as an incentive for people to take advantage of these platforms, because you're taking the burden of the finance to offer them the incentives of like 0%, same as cash for 90 days or whatever. And know that it is skewed based on the users towards the benefit of the platform provider. So the idea that it is the idyllic person that has great credit scores and stable finances and are just going to pay it off and not worry about it and everything's a beautiful place, plan always for what happens if it doesn't, and then you'll be able to go back from there on the happy parts when it does work the way it's planned. So with that, thank you for the privilege of your time for the course of the hour. Thank you for taking on, and for actually in ways inspiring this conversation as always. I will, of course, our podcast, which I do as a follow-up to this, will recap some of these items in there, plus really cool tools and techniques on some things that are very different from this. And the podcast runs from 20 to 30 minutes, a little easier to listen to. It's audio only, obviously. And you can find our podcast on 39 platforms, plus Alexa, Amazon, and Google Assistant. Just ask Play the Hospitality Marketing Podcast, and you'll get the latest episode. So you'll hear more about this on the podcast show after this as well. So once again, thank you for the content for show number 353. Thank you, everyone that's been listening and watching to us. We will recast, as always, Wednesday, 11:30 a.m. Sydney, Australian time, 11:30 a.m. London, UK time for our EU and APAC friends. Not that they don't already watch us live at the most bizarre hours. But again, my name is Lauren Gray. Thank you for the privilege of your time, and look forward to talking to you all again next week. Culture at a hotel. From whoever you connect with, and Dean, I'm talking about when we stayed at hotels in China and stuff.
Mm-hmm.
When you talk to anybody in that organization,